Today's webinar is for education only, not advice. I am not a tax, financial, or legal professional. Hypotheticals, not guarantees. Policies have caps, charges, loans reduce values, tax outcomes vary. Talk to your advisor and/or CPA. Welcome. I'm glad you made the time to be here today. Let's get right to it. If you follow the default rules, the IRS becomes your biggest retirement partner. Not your spouse, not your kids, the IRS. Here's how it works. Your money is either locked up in accounts where you're punished for touching it before a certain age, or it's tied to a market roller coaster that you can't control. And later on, the government forces you to take it out on their schedule, not yours. That's the trap most people are in right now, whether they realize it or not. And I'll say this right up front. If at any point during this conversation you feel like this isn't clearly a better option than what you're doing now, we won't move forward. That's my promise. Fair enough? But today, I'm going to show you a different path, a smarter path. We call it the flex method. Think of it as guardrails around your money, plus a harvest window you control. Inside those guardrails, your dollars keep compounding steadily without being destroyed by losses. And when life calls, when you need money, you don't have to chop down the tree. You simply pick the fruit while the tree keeps growing. In the next 30 minutes, I'll prove 3 things to you. First, why steady growth with a floor beats chasing high returns with gut-wrenching risk. Second, how you can access cash when you need it, without penalties, without panic selling. And third, how you can design income in retirement that's smarter, smoother, and in many cases tax advantaged. Now, before we dive into numbers and strategies, I want you to do something for me. Picture yourself 5 years from now, maybe 10. Close your eyes if it helps. Imagine what life looks like if money stress is no longer a daily thought in your mind. Think about waking up in the morning and not having that nagging question, am I going to be okay? Do I have enough? Instead, picture yourself with more options, less grind, more freedom, the ability to decide when you want income and how much. Imagine turning it up or turning it down like a faucet anytime you choose. Imagine not having to call a bank for permission, not having to dump investments at the worst possible time just to cover an expense, not being handcuffed by IRS rules telling you when and how to use your own money. That's the future we're working toward today. A future where you, not the market, not the IRS, not Wall Street, you are in control. Now let me give you a picture you'll never forget. Forget about banks. Forget about Wall Street charts. I want you to imagine you own a greenhouse. Inside that greenhouse, you're growing fruit trees. The glass walls protect those trees from storms, from frost, from drought, and from pests. That's your protection. Outside, the weather goes crazy. Hail, snow, blazing sun. But inside your greenhouse, your trees grow steadily. Maybe not explosively fast, but consistently, safely, year after year. Now here's the fun part. In a normal orchard, if you want to enjoy the fruit, you have to chop down branches. Every harvest comes with damage. That's how traditional accounts work. When you need money, you sell shares. You withdraw principal. You cut into the tree. And every time you do, the tree's ability to grow gets smaller. But in this greenhouse, you've installed a harvest window. You can reach in, pick fruit whenever you want, and walk away. The tree doesn't stop growing. The roots keep digging deeper. The trunk keeps getting stronger. Season after season, you get more fruit. And the greenhouse keeps doing its quiet job in the background. That's what the flex method does. It's your financial greenhouse. Your dollars are protected from storms, but they're still alive, still compounding, still producing fruit. And when life calls, whether it's payroll, tuition, a remodel, or an opportunity, you don't have to chop down the tree. You just open the harvest window, take what you need, and let the system keep working. Now pause for a second and imagine how that feels. Imagine looking at your money and knowing it's not sitting there asleep, earning pennies. It's not tied to Wall Street's roller coaster, up 20% one year and down 30% the next. It's in your greenhouse, safe, steady, growing. And whenever you need it, you can pick fruit without harming the tree. That's the flex method difference in action, growth and access. Stability and flexibility, security and opportunity. And here's the part most people miss. It's not just about having more money. It's about who you become when you know your greenhouse is quietly working for you. You stop being reactive. You stop making decisions out of fear. You stop lying awake at night wondering if a market crash just stole years off your retirement. You become the person who is calm, prepared, in control. And that identity shift, that change in who you are, that's priceless. Now let's talk about one of the most powerful forces in all of finance. It's not a stock tip. It's not crypto. It's not some get-rich-quick scheme. It's so simple that most people ignore it. Compound interest. Here's what it means. Your money earns money, then that money earns money, and then that money earns money. Over time, the growth doesn't stay in a straight line. It bends upward. And once it bends faster and faster. It's like a snowball rolling down a hill, picking up speed and size with every turn. There's a quick way to measure this effect. It's called the rule of 72. You take the number 72 and divide it by the interest rate you're earning. The answer tells you roughly how many years it will take for your money to double. So if you're earning 3% like you might on a savings account or CD, 72 divided by 3 is 24. It takes 24 years for your money to double. 24 years, that's an entire career just to turn 10,000 into 20,000. That's what I call sleepy money. If you're earning 6%, divide 72 by 6 and you get 12. That means your money doubles every 12 years. Not bad, but still not great. Now, what if you could get closer to 12% with less risk? Divide 72 by 12 and you get 6. That means your money doubles every 6 years. Now you're talking about real momentum. Let's make this real with a simple story. Imagine two friends. They both start with $10,000. They're both disciplined. They both let it sit for 24 years. Friend A earns 3% a year. After 24 years, that $10,000 has crept up to about $20,000. Friend B earns 6% a year. Same time, same effort. But at the end of 24 years, the account isn't $20,000, it's $40,000, double. And if someone averaged closer to 12%, that $10,000 would have doubled 4 times in those same 24 years, ending at around $160,000. Same start, same calendar, but a completely different finish line, simply because the speed of doubling changed. Let's stretch this even further. Take a penny, double it every day for 30 days. At first it looks like nothing, 2 cents, 4 cents, 8 cents, but by the end of day 30, that single penny has grown into over $5 million. That's the magic of compounding once the curve bends. Now here's the kicker. Most Americans are stuck crawling at 2 or 3% in savings accounts, CDs, or retirement accounts that don't grow the way they should. All the while, Wall Street, banks, and yes, the IRS are sprinting ahead, taking their share. So the real question becomes, which side do you want to be on? The side earning it or the side paying it? All right, now that we've seen how compounding really works, let's zoom out and look at the bigger picture. Because here's the truth. Most of the financial tools you've been told to use were not built for you. They were built for Wall Street, for the IRS, and for the banks. Let's just call it what it is. Let's start with retirement accounts, 401ks, IRAs, the golden goose you've been told to protect at all costs. Here's the reality. Your 401k is a tax deferral plan, not a tax savings plan. Every dollar inside has a silent partner, the IRS. And that partner doesn't just want a slice, they want a lifetime share. You think it's your account? Try touching it before you're 59 and a half. You'll get hit with a 10% penalty. Wait too long? At 73, the IRS forces you to start taking withdrawals whether you need them or not. And when you do, those withdrawals count as taxable income. They can push you into higher brackets. They can raise your Medicare premiums. They can even trigger Social Security taxes. It's like being trapped in a maze with no exits. Now let's talk about fees. Wall Street makes billions not because you win, but because they always collect management fees, expense ratios, trading costs, performance fees. If you win, they win. If you lose, they still win. Every year, 1% or potentially more is skimmed off your balance. That may not sound like much, but over a lifetime, it can mean 6 figures plus, sliding right out of your pocket and into theirs. Then there are banks. Banks smile at you and say, your money is safe here. And technically, they're right. But safe doesn't mean smart. Safe doesn't mean productive. At 0.5% interest, your savings are in a coma. Meanwhile, the bank takes your dollars, lends them out at 6, 8, even 12%, and pockets the spread. They use your money to get rich while you get pennies. That's where the flex method comes in. This isn't about chasing the hottest stock. It's not about gambling on crypto. It's not even about outsmarting Wall Street. The flex method is about flipping the rules so they finally work in your favor. Number 1, growth with protection. Most people play the market like a casino. All risk, no guardrails. With the flex method, we build on a cash value life insurance foundation that's designed for stability. In bad years, you don't go backwards. There's a floor. In good years, you capture healthy upside. That steady rhythm is exactly what compounding needs to thrive. And here's the kicker. It's not just insurance. It's a growth engine that straddles two worlds, the safety of your policy and the power of alternate investments, working together year after year. Number 2, access on demand. Try touching your 401k before age 59. Uncle Sam slaps you with penalties. With the flex method, it's different. Need money for payroll, tuition, or a big opportunity? You don't beg the IRS. You simply open the harvest window, borrow against your policy, and put those dollars to work. And because we pair that policy with alternate investments, those investments help fuel the cycle, keeping your cash value growing side by side with your cash value permanent insurance. You're in control, use it, replace it, keep compounding. Imagine a plane with just one engine, that is your 401k. Now imagine a plane with 2 engines, that is the flex method. Compounding in 2 places at the same time for greater income potential and peace of mind. Number 3, tax-free income and legacy. Traditional retirement accounts trap you in required minimum distributions at 73. Uncle Sam decides when and how much you owe. With the flex method, you decide. You design smoother, smarter income, often tax-free. And when your time comes, your family inherits both the policy's death benefit and the compounded growth without Washington draining it away. That's not just income, that's a legacy. So let's put it all together. Growth that never goes backwards, access without penalties, income you control and can pass on. That's the flex method. Insurance and investments working in harmony for you to harvest. And here's the truth. When people first see it, the reaction is always the same. Why hasn't anyone ever shown me this before? The answer is simple. The IRS doesn't benefit from you knowing. Wall Street doesn't profit if you step off their roller coaster. Banks don't make billions if you stop letting your cash sit idle. A similar strategy has been used quietly by corporations and the ultra-wealthy for over a century, but it's rarely been packaged for everyday families and business owners. That's what we do at Capvira. We put the same guardrails that protect billion-dollar institutions into your personal financial plan. Think about that for a second. Imagine never again having to ask, am I allowed to touch my own money? Imagine never again watching half your balance disappear in a market crash. Imagine never again worrying that taxes will be higher in retirement than they are today. That's what the flex method makes possible. And it's why I believe it's the smartest shift you can make for your financial future. All right, so far we've talked about concepts, we've talked about compounding, we've talked about the traps, and I've shown you how the flex method flips the script. But I know what you're thinking, okay, it sounds good in theory, but what does this actually look like in real life? Let's make it practical. Let's make it real. Let's take a look at Taylor. Taylor runs a company with 12 employees. Every 2 weeks, payroll must be covered, no excuses. But here's the problem. Receivables don't always line up with payroll dates. Clients pay late, projects drag, the money's coming, but it's not in the account yet. Most business owners in that position scramble. They pull from a line of credit, they stress, sometimes they dip into personal savings just to keep the team paid. And while all this is happening, their emergency cash is sitting in a checking account, earning almost nothing. Here's how Taylor used the flex method. Instead of leaving that reserve money idle, Taylor parked it inside the greenhouse. The cash grew steadily, compounding away, protected from downturns. When payroll came due and receivables hadn't arrived yet, Taylor simply opened the harvest window, pulled what was needed, covered payroll, and then refilled when the client checks cleared. No stress, no interest on a credit line, no idle money. The team was paid, the business stayed strong, and Taylor's greenhouse kept growing in the background. Now let's talk about Sarah. Sarah owns a niche engineering company. She has several key employees that are crucial to her business success. And like most business owners, Sarah wants to keep those key employees on her team, not working for her competitors. She wanted a way to keep them, but she didn't want to throw money away with traditional benefit options. With the Flex method, Sarah was able to create a 5-year bonus opportunity with her key employees. They agree to stay on for 5 years. Sarah pays them a large bonus. Sarah opens her harvest window, pays the $50,000 bonus with little to no out-of-pocket cost to her business, and then closes the window until she needs to give another bonus. All the while compounding tax-free income for business growth year after year. Think about that. She didn't have to sell investments. She didn't have to drain reserves. She didn't need to plug into expensive long-term 401k benefit plans. She simply accessed her own dollars in the greenhouse, used them strategically, and walked away with a profit that would have otherwise slipped by. That's what I call financial agility. Now let's step into retirement. Meet Jim and Linda, a couple in their 50s. They'd always been told to keep a big cash cushion, so they had about $200,000 sitting in a savings account. They felt proud of that, like they were being responsible. But here's the harsh truth, that $200,000 was asleep, in a coma. At 0.5% interest, it was earning them maybe $1,000 a year. That's it. Meanwhile, inflation was eating away at its purchasing power. With the Flex method, that same $200,000 was moved into the greenhouse. Instead of sitting idle, it was compounding steadily, protected from market losses. And when the roof leaked or a medical bill came due, they opened the harvest window, covered the cost, and closed it again, without stress, without panic, without selling investments in a down market. The bigger win, because their greenhouse never went backward in bad years, they could design their retirement income with confidence. No forced withdrawals, no sequence of returns risk, just steady, flexible income they controlled. And with retirement coming around the corner, Jim and Linda were excited about the potential starting tax-free income of $32,000 at age 65, and because it was a strategy for life. Jim and Linda are looking to make more contributions to increase that potential starting tax-free income. For Jim and Linda, the greenhouse didn't just grow their money, it gave them peace of mind. Now picture Michael and Anna, parents with 2 kids and a healthy emergency fund. They had about $100,000 sitting in checking, just in case. Most families feel good about that, but in reality, it was dead money, in a coma, sleeping in the bank. The bank was using it, but they weren't. Here's what happened when Michael and Anna used the Flex method. They moved that $100,000 into their greenhouse. The money started compounding, protected from downturns. A few months later, their car broke down. Instead of stressing, they opened the harvest window, took what they needed, and closed it again when they had the cash to refill. A year later, when tuition came due and their bonus hadn't hit yet, they did the same thing. Harvest window opened, tuition paid, harvest window closed. The entire time, their greenhouse kept working. Their money wasn't idle. It wasn't asleep. It was protected, productive, and available. They replaced the money they took out and even used some of their bonus money to create even more income potential. That's how the Flex method helps everyday families turn idle cash into a living resource and a long-term retirement strategy for peace of mind. Finally, let's talk about David, an entrepreneur. He'd been funding his greenhouse for years. Then one day, an opportunity landed in his lap, a chance to buy a piece of real estate at a steep discount. Normally, he would have scrambled, called the bank, liquidated stocks, tried to move fast before the deal closed. But with the Flex method, David didn't have to scramble. He opened his harvest window, accessed his dollars, seized the opportunity, and then closed the window once the deal was secure. Here's the kicker. While that opportunity played out, his greenhouse never stopped growing. The trees kept producing fruit. The compounding never paused. And David is now renting out that property and putting the profits back into his greenhouse, creating even more income potential for his retirement or another real estate buy on his terms. That's the real power of this strategy. You don't have to choose between safety, growth, and access. You get all 3. Now, I've just given you 5 different examples. Taylor, the business owner managing payroll, Sarah, keeping key employees, Jim and Linda, protecting retirement, Michael and Anna, using an emergency fund smarter, David, seizing an entrepreneurial opportunity. Different people, different situations, different goals, but the principle was the same every time. The Flex method gave them growth, gave them protection, and gave them access without penalties, without panic, and without the IRS, the government, or Wall Street pulling the strings. That's what makes this strategy so powerful. It's not a theory. It's not just numbers on a chart. It's real life, working for real people in real ways. By now, you might be nodding along. You're seeing how the flex method works, but I know what some of you are thinking. This sounds good. Maybe too good. What's the catch? Where's the risk? What am I not seeing? That's the smart question to ask. So let's answer it directly. Here are the 5 main areas people worry about and exactly how the flex method handles them. Risk number 1, market drops. The first risk is market crashes. What happens when the economy tanks? Here's the beauty of the flex method. In a down year, when the market is losing 20%, 30%, even 40%, your greenhouse has a floor. That means your growth doesn't go negative. You don't wake up one morning to see a third of your retirement account gone. Now, that doesn't mean you get rich in a down year. It just means you don't move backward. You stay flat, your base stays intact, and next year you start compounding again from the same point. That's powerful because the real killer of compounding isn't missing big gains, it's taking big losses. Avoiding those strikeouts is what makes the math work long term. Risk number 2, sky-high years and the cap. The second risk is on the upside. What about the really big years when the market goes up 20% or 35%? With the flex method, there is a cap. If the cap is 10%, you get 10%, not 25%. Some people see that and say, that's a downside. But remember, compounding doesn't require fireworks. It requires consistency. This is the turtle that turns into a rabbit. You're trading the emotional roller coaster, huge ups, followed by gut-wrenching downs, for a steadier, more predictable path. You may not capture every moonshot, but you also don't ride the elevator down when Wall Street throws a tantrum. That steadiness is exactly what makes the compounding curve bend faster. It is what helps you sleep at night. It is what gives you peace of mind and security. Risk number 3, loan costs. Now, some people ask, but wait, if I'm borrowing against my policy, what if interest rates rise? What if it feels expensive to borrow? Here's the truth. You hold the steering wheel. Nobody forces you to borrow. You decide when to open the harvest window, how much to take, and how long to keep it open. That's pure control. Historically, rates to borrow have been around 4.5%. And if and when bank rates lower, you can take advantage of lower rates. But here's the power play most people miss. With the flex method, you're not just borrowing to spend, you're borrowing to create arbitrage. Now don't panic, that is a big word. Let me explain. Imagine you go to the candy store. You see a chocolate bar that costs $1. Right next door, another kid really wants that same chocolate bar and is happy to pay $2. So you buy the candy for $1 and sell it for $2. You just made $1, not because you made the candy, but because you spotted the difference in price and used it. That's arbitrage. It's like finding the same toy, snack, or game selling for 2 different prices and making money by buying it cheaper and selling it higher. You borrow at one rate and you put those dollars to work harder where they can earn more. That spread, that gap between cost and growth is what accelerates your wealth. It superpowers your compounding in safe, controlled ways. And we never let the engine run hot. Why? Because your death benefit backstop is massive. Loans typically are less than 50% of the death benefit. That means you're never over-leveraged, never at risk of tipping the balance. It is like that good friend that always has your back no matter what. This isn't gambling. This is controlled leverage with guardrails. Think of it like this. Inside your greenhouse, your cash value keeps compounding safely year after year. Outside, you use carefully chosen harvest windows to capture opportunities, bridging payroll, grabbing tuition, or investing where the return beats the cost of capital. And when that growth outpaces your loan rate, the interest you pay is tiny compared to what you gain. You never borrow against your cash values unless you can get more money on the outside. Simple as that. Now don't worry, put your mind at rest. There is an entire team that is there to make all the movements and orchestrate everything in the strategy, from beginning to end, meeting with you whenever you need it. You are not doing this alone. Bottom line, you're not borrowing because you have to. You're borrowing because it makes you money. And that's the kind of control that separates people who just get by from people who build a legacy. Risk number 4, taxes. Next, let's talk taxes. The dollars you put in are after-tax dollars. You've already paid tax on them. Later, if the policy is designed correctly, and I mean correctly, you can take income out through loans in a tax-favored way. And that is a massive advantage, taking your income without the impact of massive taxes. Given the $34 billion deficit, our tax future is uncertain. This provides peace of mind. But let's be clear, if the policy isn't structured properly, or if it's overloaded with costs, you could run into problems. That's why we don't cut corners. That's why every design we build goes through a professional review, and why we encourage you to have your CPA or accountant give it a thumbs up. Transparency matters here. No gimmicks, no fine print, just design it right and it works the way it should. And if you have pre-tax dollars, money in a retirement account, we can give you options to compare what doing nothing or making a positive change can do to your growth long term. Risk number 5, insurance carriers. And finally, let's talk about the carriers themselves. At the end of the day, the policy is a contract with an insurance company. So naturally, you might ask, what if the company isn't strong? What if they collapse? That's the right question to ask. Here's the answer. We don't play favorites. We line up the top-rated carriers side by side. You see their actual numbers, their caps, their costs, their loan rules in black and white. And we only use carriers with strong financial ratings, the kind that have weathered wars, depressions, recessions, and pandemics without missing a beat. The permanent insurance policy is your key to leverage, control, and compounding tax-free growth. So again, no secrets. You see the numbers, you compare, you choose. So let's recap. What are the real-world risks? In bad years, you don't go backwards. That's the floor. In great years, you give up some upside. That's the cap. Loans have costs, but you are making more on the spread. That's control. Taxes require careful design, so we build it right and confirm with your CPA or accountant. Carriers matter, so we compare only the strongest ones. That's it. No magic, no mystery, just clear, simple trade-offs. And here's the question you need to ask yourself. Would you rather have a system with risks you can see and control, or a system where the risks are buried in fine print, hidden in prospectuses, and waiting for the next market crash to show up? That's why I believe the flex method isn't just safer, it's smarter, because the rules are on the table. You know them up front, and you get to decide if the trade is worth it. So let's land the plane. You came here today because you wanted something better, safer, smarter, more controllable. And over the last 30 minutes, you've seen exactly how the flex method delivers that. Let's do a quick review. We talked about compound interest, the eighth wonder of the world, and how it either works for you or against you. We looked at the traps of traditional accounts, 401ks, IRAs, banks, Wall Street, and how they were designed for someone else's benefit, not yours. We explored the greenhouse, steady compounding inside, storms blocked outside, fruit you can harvest whenever you need it. We walked through real-life examples, business owners bridging payroll, parents paying tuition, retirees finding peace of mind, entrepreneurs seizing opportunities. We addressed the risks, floor, cap, loan costs, taxes, carriers, and laid them all on the table. Nothing hidden, nothing buried. Now you're standing at a crossroads. One path is the old way: volatile markets, idle cash, forced withdrawals, sleepless nights. The other path is the flex method: steady growth, on-demand access, tax-smart income, and a legacy that passes to your family instead of to the IRS. 5 years from now, you'll be in one of two places. You'll either be grateful you started today or wishing you had, because compound interest doesn't wait. It doesn't hit pause while you think about it. It either works for you or it works against you. And this is bigger than just money. This is about identity. Do you want to be the person who's always reacting, hoping the market bounces back, waiting for Washington to change the rules, lying awake at night wondering if you'll outlive your money? Or do you want to be the person who's calm, prepared, in control, because you know your greenhouse is quietly working for you, day in and day out? That's the real shift the flex method creates. Not just more dollars, but more peace of mind, more confidence, more freedom to make choices based on your life, not someone else's calendar. Real guardrails for your life. So here's my invitation. Let's put your current setup side by side with the flex method. If my version isn't a good alternative option for your life strategy, if it doesn't give you steadier growth, more control, and greater potential income, then we shake hands and part as friends. No pressure, no gimmicks. But if it does give a good alternative, and I believe it will, then today can be the day you step out of the trap and into control. The IRS isn't waiting. Wall Street isn't waiting. Inflation isn't waiting. Every year you delay is another year you give away compounding to someone else's benefit. You deserve better. Your family deserves better. Your business deserves better. So my friends, if you're nodding yes, if you're ready to step into control, here's what I want you to do. Click the button you see on the screen, book your free Guardrails Strategy call. In that call, we'll run your numbers, build your legacy leak report, and map out exactly how to put guardrails around your money. If the numbers don't work, no harm will be done. But if they do, then today is the day you move from paying it into earning it. Here's what happens when you click the button and book your free Guardrails Strategy call. Step 1, we run your numbers. We'll show you exactly how much of your wealth the IRS is positioned to inherit under your current plan. That's your legacy leak. Step 2, we map your side-by-side, traditional retirement path versus the flex method. Same dollars, same timeline, two very different outcomes. Step 3, you walk away with clarity. If our version doesn't clearly give you more growth, more control, and more legacy for your family, you don't move forward, period. Think about that. In 30 minutes, you'll know what the IRS isn't telling you, what Wall Street won't show you, and what most advisors never talk about. But here's the key. You have to act now. Every year you wait is another year the IRS claims a bigger slice of your future. Every year you delay is another year compounding works against you instead of for you. So ask yourself, how much longer are you willing to let your money sit idle? How many more years do you want to ride the roller coaster? How many more times do you want to watch the IRS win? Click the button. Book your free Guardrails Strategy call. Claim your legacy leak report before you pass another year of sleepy growth, wishing you had done something different. You've worked too hard to let someone else write the ending to your story. Take control, build your greenhouse, protect your family, and put guardrails around your future. I'll see you on the call.